Defying political jitters. What is driving the market up? Good evening. Thank you very much indeed for joining us. I'll be posing this question to Mercy Gatembi. She's a research analyst at Kingdom Securities. She'll be joining me later on to help us understand where the market is going. And of course, for now, we talk to Arthur Kamp. He's an economist at Sanlam, South Africa. This is the Trading Bell. My name is O'Brien Kimani. Always we're coming to you from the trading floor of Nairobi Securities Exchange. And this is KBC Channel 1. Let's go to Arthur Kamp. Arthur.
Hello, Brian.
It's nice to meet you.
Thank you.
Good. Thank you. Please take position.
Thank you.
You are an investment economist based in South Africa, and we know the challenges that the South African economy has been going through. I want you to give us a power view of your focus when you look at the Kenyan economy. What exactly do you see, bearing in mind that we are coming from a very tough operating environment, debilitating drought, the interest capping low, and of course we are heading to the general election. All these coupled together, what do you make of the future ahead?
Brian, when I look at the Kenyan economy, the first thing I still see is growth. So even though we're in a slowdown phase, the South African economy, the last 2 quarters have been negative growth. We've been in recession. And so this is one of the things that makes Kenya so attractive globally, is the fact that global growth is still relatively moderate. Certainly in current prices, the global economy is growing at 2/3 of the pace it was for a long time before the global financial crisis. So investors are looking for growth. That's the first thing I see. So if I look at the near term, sure, there's maybe a bit of uncertainty about tourism receipts. The drought lingers too long, that is problematic. And perhaps some of the public sector investment projects aren't coming on stream as fast as one would like, and these could be near-term breaks. But I think when I look at the Kenyan economy and I look at the underlying factors that drive growth in the longer term, it explains why investors still put a lot of foreign direct investment into Kenya and why they still think that there's a good long-term growth story. So sure, we can talk about near-term slowdowns, and I think you're absolutely right that we're in a patch like that. But hopefully investors will still remain focused on the longer term story. And I think there are quite a few reasons to remain optimistic on that front.
And of the three things that I have talked about, the interest capping low, the elections and the drought, plus when you factor in, the external factors that are affecting the world, what do you see as the biggest challenge facing the economy?
Well, in terms of near-term growth, the slowdown in credit extension, and this is across numerous countries in East Africa, lost quite a bit of vibrancy there. We saw non-performing loans go up a little bit. And in Kenya, we have the debate around the interest cap, 4% above the central bank rate, and deposit rates being 70% of the central bank rate. So the issue around that would be, in particular, I've seen this globally, is that in the post-global financial crisis environment, real interest rates have been low. So risk-free rates in countries like the US and the developed markets, which the rest of the world, emerging markets, including Kenya, Kenya's increasingly becoming integrated with global capital markets, benchmarks of those rates. And those real interest rates are very low, if not negative in some cases. And when we look at that, we say, well, then credit extension should be picking up because real interest rates are low and demand for credit should be decent. But that's not been the case everywhere. And the reason for that is that the suppliers of capital, savers, are saying the real interest rate is too low to reward us for the risk. And so the risk for Kenya in an environment where you try and cap the lending rate is if banks think that the real interest rate is too low to compensate for the risk, or if they cannot assess the risk accurately of, say, a small business or individuals, they may be in that environment less inclined to lend. Alternatively, what could also happen is that you get lending outside of the formal system. And so the chance is that rather than actually promoting credit extension, what happens is that you have a slowdown in credit extension. And it would be worth considering those arguments. We've seen it elsewhere, and we saw it in South Africa as well, where banks, I think my opinion is that faced with low real interest rates, might not have been as confident to give someone a mortgage for 20 or 30 years in an environment where they weren't sure if that person would stay employed. But in some instances, they were prepared to lend to people against unsecured lending but very high real interest rates. So even though the default rates were very high on those loans, the interest rate was so high that it compensated for that. But they were only prepared to lend where they felt they were getting the return. So this is a global issue. And in a way, it's an argument that globally, real interest rates are too low, and one must be careful that that doesn't then prevent suppliers of capital from funding the market. The other issues facing Kenya is drought, because agriculture is still a fairly big part of the economy, not just directly, but because of the manufacturing as well. So in the near term, this could have a significant influence. But I think as we go in the next couple of years as well, as far as interest rates go, I say global real interest rates are low, but there is something of a risk that what is happening now is that because they're so low that you're getting this mispricing, in my opinion, of capital globally. And that speaks to the less efficient allocation of capital. And I think central banks in the big developed economies may well shift towards tighter monetary policy stances. And that could include, and this would be important again, as I say, Kenya increasingly being integrated with the global economy, its capital markets, is that in the next few years, these central banks could shift towards less balance sheet expansion and eventually contraction of their balance sheet. So they'll be buying less assets, so they'll be putting less liquidity into the world. And that potentially could mean less liquidity available for emerging markets generally. And if that is the case, then one must watch one's, obviously reliance on foreign capital, and it would be quite important to continue with a fiscal consolidation program.
Very well. And when you look at the capping, the interest capping law, and we know for sure that Kenya has been a very attractive market, especially with the foreign investors, because of high interest and high returns on the bond market. But now we have seen somehow the investors are shying off from the market because, of course, the returns are not as sexy as they used to be. To what extent do you think that law that came into effect last August is likely to scare away investors?
I think there are a few types of investors. So on the portfolio front, portfolio type investment, maybe there may be an impact, although if my understanding is correct, then the law doesn't apply to Forex loans and deposits. And so you may find that more of that is then actually issued. So that could in time then expose one to Forex fluctuations. That would be the one thing. But I think what is encouraging, and I think when it comes to Kenya's story, and this is hopefully a more durable story, is that foreign direct investment inflows are a significant proportion of GDP. It doesn't cover the entire current account, but that's really the type of stable long-term investment. Portfolio flows will come and go with global financial conditions and will create volatility in the currency. And there I have encouragement that the Central Bank of Kenya seems to allow currency adjustment when it's necessary. We know that they have a standby facilities with the IMF. We know that the current account deficit has at least halved in the last few years, that the foreign exchange reserves is building over 5 months of prospective imports being covered. So I'm not overly concerned about the balance of payments position, and it's the central bank has credibility, and in particularly if the currency were to weaken, it has its inflation target, and if it sticks to it, it could even, and the currency were to go, you would get the benefit of the real depreciation. So I'm not particularly concerned about that. One doesn't want volatility. Volatility in asset markets in the near term is not pleasant. But I'm not that overly concerned about it, and I am encouraged that the FDI flows. And that's important because what that means is that Kenya needs to continue shifting to improve its institutional strength. Because it's got a sophisticated financial system, it's got a deepening financial system, and now it's at the stage where we need to move towards increasingly looking at the institutional strength to support that system, and which would also help drive total factor productivity in the long term, which would make a contribution to growth. Because if the growth stays, and growth in the medium to longer term stays robust, hopefully that FDI should continue coming. And
where do you see growth coming? And we know for sure that the economy has been very consistent, especially on a growth trajectory. It has always been up, for the last 4 to 5 years. We have seen an inflation, edging higher, on a 4-year record. We have seen the government becoming very active and very heavy when it comes to borrowing, now standing at almost 52% of the GDP. Where do you see growth coming, and how do you expect these two issues to impact growth?
Well, if government is embarking on a fiscal consolidation program, and if that were to start limiting the ability of government to deliver on big infrastructure projects because of funding, or whether it be capacity, that would be an opportunity to involve the private sector. So if the government is on a fiscal consolidation program, the onus does start shifting towards the private sector to help carry growth, public-private partnerships. Now, in the near term, there's a lot of uncertainty. So again, drought and relief of the drought conditions would be a huge boost on a base effect. Tourism receipts, I know the trend in recent years has been much more encouraging. Tourism, as we've seen in countries like South Africa, is a very, very important earner of foreign exchange and makes a very important contribution to the economy. And then also I think that if one looks at the underlying drivers of longer term growth, when it comes to demographics, Kenya's still got very favorable factors there. And then also particularly, I tend to get quite excited when I see a high level of urbanization, because yes, it does result in traffic congestion in the near term and infrastructure bottlenecks. This is not uncommon in emerging markets. But a process of urbanization is very typically one where one shifts into a phase where there's more manufacturing and more services, which is much more productivity enhancing, and that helps to carry growth in the longer term. And there are potentially other exciting developments as well if they handle properly. For example, hydrocarbons, and the impact that this can have in the economy could be quite material. So if the economy stays open to foreign direct investment, allows the private sector to lead the way on growth, the private sector is a good driver of productivity. We've seen this globally, and productivity growth is what sustains growth in the longer term. So stay open, stay engaged is what I would say.
And because we have to come to the end of this interview, I also want to find out from you, and we know for sure that Kenya has been an economic star performer on this side of the world for quite a long time now. Do you see this momentum being maintained? And if there is one thing that you are to do in order to accelerate this, what would you do?
Well, I think one of the more important developments is the integration of the East African countries. And trade. So globally, in the USA, for example, we potentially have a regime in place that wants to stall global trade liberalization. And what's been very encouraging for me is that the East African region does not appear to be going that route. Trade liberalization is a very, very powerful driver of growth. Internally, Kenya has the 2030 vision. And Kenya is at the point now where it needs to strengthen its institutional strengths. And these have all been mentioned by government, and it relates to issues that help to strengthen and underpin the financial sector. Financial sector development can be quite a powerful driver of total factor productivity growth, because what the savings industry does is it allocates savings more efficiently, it diversifies risk, it smooths consumption and investment spending through its products, and combined with that, what you need is all the usual stuff you get around the globe. Auditing standards, reporting standards, good governance, an independent judiciary that enforces contractual laws, property registries that help with collateral for getting loans. All these things are important, and if one continues to drive in this direction, particularly helpful as well. And then I did see in the budget, I don't know if it's been followed through on, but the special economic zones, and also particularly the potential tax incentives there. This again speaks to the idea of trade liberalization and integration. I think those are powerful forces of
that will
growth.
drive growth. Arthur, thank you very much indeed for joining us on the Trading Bell.
Thanks, Brian. I appreciate it.
Indeed. Appreciate it. Arthur Kamp is an investment economist at Sanlam Group in South Africa, joining us here to help us understand what is happening with the Kenyan economy and what the future holds for the economy. You're watching the Trading Bell. We're taking a short break, and thereafter we'll be back with more. Stay right here. there you have the figures of how the market performed in the last 1 week. Mercy Tembi is a research analyst at Kingdom Securities, joining us here on the Trading Bell. Thank you very much indeed, Mercy. First of all, I want to find out from you, you know, the market defied all expectations that we are likely to see a major dip because of the elections. So far, it has appreciated by about 11%. What is driving this growth?
Thank you, Kimani, for hosting me today here. Maybe what I would attribute the movement that you have seen on the market now is because we have seen a lot of investors who are actually doing profit taking. The investors who came into the market when the market was really low, but now we are seeing investors who are coming into the market to actually do some profit taking. So these the demand that has been created in the market is actually what is causing the prices to really shoot up and significantly to also cause the market to really rally and improve. So I wouldn't term it as very permanent because so far we don't have fundamentals supporting that, the market to be in that position for now. But I think it's something that probably over time, maybe investors are going to actually grow wary, especially now when we come to the tail end of the financial announcements and tail end of some corporate actions like book closures for some companies. I think we're going to see some pullback in the market, but not maybe to take us back to the levels that we have seen before. Yeah.
And we have seen the NSE 25 share index, you know, jumping all the way from the figures of around 3,500 now to around 4,500. The question is, how higher can it go from here?
Well, for the NSE 25, I think it's an index that many investors have been very keen on because, one, the good thing about it is that it's price weighted as compared to the NSE 20, which is market cap weighted. So the good thing about having a price weighted index is that it reflects it reflects a better picture of what is actually happening in the stocks themselves, other than maybe the NSE 20 index, which is purely driven by maybe a few stocks which are actually trading very significantly in the market or which have a very high turnover. So looking at the performance for the NSE 25, I think my expectations are that it's going to continue building momentum. You're going to see the NSE 25 keep building momentum maybe till the end of the year, but not as compared to the NSE 20, which is vulnerable to some stocks which are actually going to start dipping, especially after the book closure like Safaricom. Yeah.
And of course, we expect the Supreme Court to make a decision in regard to the presidential results. How do you expect the market to react?
Well, we didn't see any reaction during elections. I think there were still investors in the market who are really keen on even buying at that time. And I think even now, where we are right now, we have already seen some resumption of activity in the market. Foreign investors are already back into the market, like not how it was 2 weeks ago. So I think going forward, what I expect is that even after the Supreme Court ruling, I think these may not significantly affect the stock market because now investors are actually appreciating that Kenya is a bit more politically stable as compared to previous years. Yeah. And
when you go to different counters, like when you go to top gainers, we have Kenya Power and Lighting Company jumping by 8%. What is driving this growth?
For Kenya Power, I think all fundamentals lead to a good stock, especially for investors looking for long-term growth of their capital. I think Kenya Power has a lot of potential. Looking at the work they have been doing in terms of now ensuring that on the last mile connectivity, I think that has also helped in actually growing the top line numbers. And thus we have seen a lot of growth when it comes to the top line. Again, for Kenya Power, we are expecting that they'll be announcing their results, the full year results, and all indicators are pointing to some relatively stable results from the company. So investors are banking on that they hopefully are going to give a full year dividend. So we expect to see some activity on Kenya Power and also to see the momentum keep growing. Yeah.
Is it being driven by fundamentals or sentiments?
For Kenya Power, I think there's still some fundamentals to it because most of the investors actually coming into Kenya Power, they're long-term investors. They are not basically investors who are investing on sentiments. So I think investors are banking on the fact that they hope that Kenya Power is actually going to pay a full year dividend, which they want to actually be in the books before they close the year. Yeah.
And of course, on the top losers, we have Limuru Tea. Quite a pricey share here, 600 shillings, you know. Losing about 10%. Why? Could this be because of the drought or what?
So far, what we've seen with agriculture companies, Kimani, I think we have already witnessed some of these companies posting not very good results because of the fact that most of these companies really rely on the weather conditions. So there are seasonal factors which end up affecting the companies, and as such, also the performance of these companies can also be affected. So for Limuru Tea, I think most of the time we see it trading on odd lots. I mean, like if you look at the trades, maybe the volumes which traded for it to come down this much probably could have been as a very small amount of shares. So also Limuru Tea is a bit illiquid and we don't see a lot of activity on it. So as one investor can actually cause the stock to actually fluctuate. Yeah.
And finally, is this the best season for short-term investors?
Short-term investors, no. I wouldn't say this is the best time because one, there's a lot of volatility in the market now, especially coming from a point where coming from elections, a political season. I think it's best for a short-term investor maybe to look at stocks which are they are cheaply priced. There are counters which have actually been speculative in the market. We have Kenya Airways, we have Mumias. We also have Home Africa and a few other stocks. I think if you're to look at a short-term perspective, the only beneficiaries in a short-term market, they are mainly the speculators. But for investors who are actually fundamentally driven, I don't think this is the best time for them to look at short-term investments.
Marcy, thank you very much indeed for joining us.
Most welcome.
Marcy Katembi is a research analyst at Kingdom Securities, joining us here on the Trading Bell to put the figures in the right perspective. You're watching Trading Bell, stay right here.
My name is Josephine, and I would like to ask whether there is any factual evidence that I'll make money buying stocks.
Thank you, Josephine, for the question. Just maybe to respond to what you asked, basically you can make money from shares, but it all depends with the time that you're looking at. Every investor has the investment objectives. So if you want to make money, it depends on whether you want to make it as an income stream or you want to make profits from your capital. So definitely you'll have to evaluate what your investment objectives are. So for instance, if you want to make profits from your capital, then it means you have to invest, and after a particular time, maybe when the share price goes up, then now you can make a capital gain from that. If you want to make an income, investors actually make income from now the dividends that companies make. So definitely you can make money from the shares market.
From the camp hailing the Kenyan economy to Marceline Gatembi lauding the performance of Nairobi Securities Exchange. This kind of stuff, you can only get it right here on the Trading Bell. Thank you very much indeed for being part of us this evening. We'll do this again next Thursday, same time right here on KBC Channel 1. My name is O'Brien Kimani. Well, for you to communicate with us, all the communication avenues are open. They are here with you. You can get through me at O'Brien Kimani, at KBC Channel 1, at The Trading Bell. Our Facebook page is The Trading Bell TV Show. Until next Thursday, have yourself a good time.